Hi everyone, in this video we will be going over A-Level Accounting 2022 February-March Paper 3-2 question number 6. This is the structured paper 3 which consists of 6 questions. Each of them will be of 25 marks and we're also given a time limit of 3 hours, which means that ideally we should be spending about 30 minutes in order to complete each question, and in this video as well we will be attempting to solve this question number 6 under 30 minutes. So without any further delay, let's get started. The directors of J Limited plan to buy a machine costing 550,000. The machine has a useful life of 4 years with no residual value, which means that we can just figure out the depreciation charge per year with the formula cost minus our residual value divided by expected useful life. Then it is expected that the machine will generate a net cash flow of 200,000 for each of the first 2 years, followed by a decrease of 10% in year 3 and a further decrease of 10% in year 4. And we're also told that the cost of capital is going to be 10%. So I'm just going to write down the cash inflows. For the first year, that's going to be 200,000. And for the second year as well, it's going to remain the same. And then we're told that in the third year, there will be a decrease of 10%. So that is just going to be 200,000 times 1 minus the decrease of 10%, right? So that we can write down as 0.10, which results in the amount of 180,000. So this is going to be the cash inflow for third year. And then we're also told that there will be a further decrease of 10% in year 4. So that is just going to be 180,000 times 1. Again, since this is a decrease, so that will be minus 10%, which we can write down as 0.10. And this results in an amount of 162,000. So the cash inflow for year 4 is going to be 162,000. All right. Then we're given the discount factors at 10% and 16%. For the first part of this question, we need to explain what is meant by the term cost of capital. So cost of capital is basically the cost of financing an investment. And the financing can be done through either debt or equity, right? And the cost of capital is also the minimum required rate of return for an investment. So if our rate of return for any sort of investment is lower than that of the cost of capital, then the company should not follow that investment or go with that proposal or plan. Let's write it down. It is the cost of financing an investment through debt and or equity, and it is also the minimum rate of return for an investment. This concludes the first part. Let's move towards the second one. Now, for the proposed investment, we need to calculate the payback period in years and months. So payback period is just the amount of time in which our initial investment will be returned. So let's have a look above. So we need to purchase the machine costing 550,000. So this is our initial investment. Then we can see that in the first year, we get 200,000 back, which means that now our remaining initial investment is just going to be 550,000 minus 200,000, which is 350,000. Then after second year, we get the inflow of 200,000, which means that our remaining initial investment that we are yet to get back is just going to be 350,000 minus 200,000, which results in 150,000. For the third year, we get a return of 180,000, and this amount can easily cover our remaining initial investment of 150,000, right? So this just means that our payback period is somewhere between the years 2 and 3. So that will be 2 years. Now, in order to figure out the month, we need to figure out the amount that we need to cover from year 3. So that is just going to be 150,000, right? And the total amount that we're getting in year 3 is 180,000. So we just write down its ratio and then multiply it with the number of months in a year. So that is just going to be 150,000 divided by 180,000 times 12 months. So this gives our payback period to be 2 years and 10 months. All right. Now we need to figure out our accounting rate of return. So the formula for accounting rate of return is average profit divided by our average investment. Okay, first of all, let's figure out the average profit. So average profit is just going to be all of our cash inflows minus our depreciation. And in this case, we are clearly told that there is no residual value, which means that the total cost will now be the total depreciation charge for 4 years, right? So what we need to do in order to figure out our average profit is just add all of our inflows, then subtract this initial outflow, and then divide it among the 4 years. So let's do that. We have 200,000 for 2 years, so we can just multiply it by 2. Then we have 180,000 for the third year and 162,000 for the fourth year. Then our depreciation is going to be minus 550,000, which is the initial cost. Then we just divide it by the total number of years, which is 4. And this gives the average profit to have the value of 48,000. Now let's figure out our average investment. Average investment is just going to be our initial investment divided by 2. And in this case, the initial investment was the cost of the machine of 550,000. So that's 550,000 divided by 2, which results in 275,000. Now we can easily figure out our accounting rate of return. So that's 48,000 divided by 275,000 times 100%. And this gives our accounting rate of return to have the value of 17.45%. Okay, now for the third part of this question, we need to calculate the net present value. The number of years is just going to be 0, 1, 2, 3, and 4. Then let's write down our cash flows. So at time 0, our cash flow is just going to be the initial investment, which is an outflow, right? And in order to represent that outflow, I'm just going to write that amount in a bracket. So that will be 550,000 in a bracket. Now the cash inflows for year 1 and 2 were 200,000. For year 3, it was 180,000. And for year 4, that was 162,000. All right. Now we just need to multiply these cash flows with our cost of capital. Let's have a look above. So the cost of capital is 10%, which means that we need to multiply it with the discount factors at 10%, which is given to be 0.909, 0.826, 0.751, and 0.683. Let's write it down. So these are the discount factors at 10%. And for year 0, the discount factor is always going to be 1, regardless of the rate. Now for year 1, it was given to be 0.909. For year 2, it was 0.826. For year 3, it was 0.751. And for year 4, it was 0.683. Now we need to figure out the net present value. And the net present value is just the product of cash flows and our discounting factors. So for year 1, that is just going to be 550,000 times 1, which again results in 550,000. For year 1, that's going to be 200,000 times 0.909, which results in 181,800. For year 2, that's 200,000 times 0.826, which results in 165,200. For year 3, that's 180,000 times 0.751, which results in 135,180. And for year 4, that will be 162,000 times 0.683, which results in 110,646. Now, in order to figure out the total net present value, we just add these 5 amounts. So that will be minus 550,000 plus 181,800 plus 165,200 plus 135,180 plus 110,646, which results in 42,826. This is our net present value. All right, let's move to the next part. We now need to figure out the internal rate of return. So the formula for internal rate of return is lower rate plus the difference between the rates. So that is just going to be higher rate minus lower rate. And then we divide it by the difference of NPV. So that is just going to be net present value at lower rate minus net present value at higher rate. We then multiply it with our net present value at lower rate. Okay, so we already know that the two rates given were 10% and 16%, which means that the lower rate is going to be 10%. Then our higher rate is 16% minus the lower rate is 10%. We then divide it by the net present value of lower rate, which is just the net present value at 10%, which we figured out in the third part. That is 42,826. Let's write it down. So that's 42,826 minus, we are yet to figure out the net present value at higher rate. So I'm just going to leave that space as a blank. Then we multiply it with the net present value at lower rate, which is again 42,826. Now we need to figure out the net present value at higher rate. All right, so I'm just going to do that in the net present value section. So we now require the discount factor at 16%. So let's have a look above. It is 0.826, 0.743, 0.641, and 0.552. Let's copy these numbers. Again, like I said before, for year 0, the discount factor is always going to be 1 regardless of our percentage or rate, right? Now for year 1, it was given to be 0.862. For year 2, it was 0.743. For year 3, that was 0.641. And for year 4, that was 0.552. Now let's figure out the net present value at 16%. So we now need to multiply the cash flows with this discount factor. So for year 0, that will be negative 550,000 times 1, which again result in negative 550,000. Then for year 1, that is 200,000 times 0.862, which results in 172,400. For year 2, that is 200,000 times 0.743, which results in 148,600. For year 3, that is 180,000 times 0.641, which results in 115,380. And for year 4, that will be 162,000 times 0.552, which results in 89,424. Now the net present value at the higher rate of 16% is just going to be the sum of these 5 amounts. So that's minus 550,000 plus 172,400 plus 148,600 plus 115,380 plus 89,424, which results in the negative balance of 24,196. This is the total net present value. Alright, so let's copy this amount into our formula for internal rate of return. And we need to subtract that amount. But remember that the amount is already a negative value. So two negatives make up a positive. So that will be plus 24,196. Now this gives our internal rate of return to have the value of 13.83%. Okay. Now for the third part of this question, we need to advise the directors whether or not the company should purchase the machine by justifying our answer. Alright, so let's have a look at our payback period. We know that the life of the machine was 4 years and the payback period is 2 years and 10 months, right? Which is within the life of the machine. So this indicates that the payback period is good. Let's write it down. The payback period is within the life of the machine. Now let's talk about net present value. We can see that the net present value at the required cost of capital is 42,826, which is a positive value. And whenever the net present value is greater than 0, it indicates that the investment is good. So let's write it down as well. The net present value is positive. Now let's talk about the internal rate of return. We just figured it out to be 13.83%, which is higher than the cost of capital. And whenever the internal rate of return is higher than the cost of capital, it again indicates that the investment is good. Let's write it down. The internal rate of return is higher than the cost of capital. And here the payback period, the net present value, as well as the internal rate of return has been indicating that this investment is a good one, which means that we need to suggest the directors to purchase the machine. Let's write it down. The directors should purchase the machine. This concludes the third part. We can now move towards the fourth one. We are given additional information. The directors decide to use the net present value method for investment appraisal, and due to recent adverse economic conditions, the directors think that they should use a cost of capital of 16%. So previously, we were considering the net present value at the cost of capital of 10%, but now the cost of capital has been increased to 16%. And for the fourth part of this question, we need to explain the impact on the director's decision to purchase the machine if the cost of capital is 16%. Let's have a look above. We figured out the net present value at 16% as well, which had the negative amount of 24,196. And like I said before, if the net present value is greater than 0, it suggests that the investment is a good one. But if the net present value is lower than 0, it suggests that this investment is a bad investment, which means that now the impact will just be that the machine should not be purchased since the net present value is negative. Let's write it down. The net present value is negative. Therefore, the machine should not be purchased. Alright, this concludes the fourth part. We can now move towards the fifth one. We're given additional information. In the view of the increase in the cost of capital to 16%, the directors consider that the net cash inflows for each year need to be improved. Now we need to calculate the net cash inflows for each of the 4 years so that the net present value of the proposed investment is 0. So I'm going to figure out the net cash inflows in the easiest way possible. Alright, first of all, let's have a look at our given information. So regarding cash inflows, we know that the cash inflows were fixed amount for the first 2 years, and then it decreased by 10% in the second year, and it decreased by further 10% in the fourth year. So the most easiest way to complete this process would be to figure out this initial amount. Okay. So I'm just going to write down let X be the net cash inflow for the first 2 years, because it was the same for the first 2 years, right? Okay, now let's prepare a format in order to calculate our net present value. So we start with our years. So that's 0, 1, 2, 3, and 4. And then we write down our net cash inflows. So the net cash inflows for the first 2 years is going to be X. And our initial inflow does not change, so that is just going to be 550,000. And we know that for the third year, we now need to decrease this amount of X by 10%. So that is just going to be X, 1 minus 10%, which you can write down as 0.10. So this results in 0.90X, right? So that will be the net cash inflow for third year. Now for the fourth year, we again need to reduce this amount by 10%. So that is 0.90X, 1 minus 10%. So this is just going to be 0.90X times 0.90. So now the cash inflow for the fourth year is going to be 0.81X. Okay, then the next step would be to multiply it with our discount factors, and we are utilizing the cost of capital of 16%. So these are the discount factors at 16%. Let's have a look above. So at 16%, our discount factors were 0.862, 0.743, 0.641, and 0.552. And for year 0, that's going to be 1. So that's 0.862, 0.743, 0.641, and 0.552. Now we can figure out the net present value by multiplying our net cash inflows with our discount factor. So for year 0, that is 550,000 times 1. For year 1, that is x times 0.862, so that's 0.862x. Then for the second year, that's x times 0.743, so that's 0.743x. For the third year, that is 0.90x times 0.641, which is 0.5769x. And for the fourth year, that is 0.81x times 0.552, which results in 0.44712x. Now, the condition that we require is for the net present value to be 0, which just means that the sum of these 5 amounts should be 0. Okay, so I'm just going to write down our net present values in an equation form. So that's going to be minus 550,000 plus 0.862x plus 0.743x plus 0.5769x plus 0.44712x, and this should be 0. So let's bring this to the opposite side. So that will be 550,000 equals to, now let's add up all of these. So that's 0.862 plus 0.743 plus 0.5769 plus 0.44712, which results in 2.62902x. Now we can easily figure out the amount for x. That's going to be 550,000 divided by 2.62902. And this results in the amount of 209,203.4294. Alright, we also need to verify if this is correct or not. So let's again create this same schedule in order to figure out the net present value, but now in place of x, we will be inserting the amount of 209,203.4294. So that's years 0, 1, 2, 3, and 4. Then we have net cash inflows. So for year 0, that is negative 550,000. For year 1, that's 209,203.4294. The same for year 2. And for year 3, it was 0.90x. So that's going to be 0.90 times 209,203.4294. And this results in the amount of 188,283.0865. So that's 188,283.0865. And for the fourth year, that was 0.81 times x. So that is 209,203.4294. And this results in the amount of 169,454.7779. Alright, now we need to write down our discount factors at the rate of 16%. For year 0, that's 1. Let's copy the amounts for the remaining 4 years. So that's going to be 0.862, 0.743, 0.641, and 0.552. Now let's figure out the net present values by multiplying our net cash inflows to the discount factors. For year 0, that is negative 550,000. For year 1, that is 209,203.4294 times 0.862, which results in 180,333.3561. For year 2, that's 209,203.4294 times 0.743, which results in 155,438.148. For year 3, that's 188,283.0865 times 0.641, which results in 120,689.4584. And for year 4, that is 169,454.7779 times 0.552, which results in 93,539.0374. Now let's figure out the total net present value. That is going to be the sum of these 5 amounts. So that's minus 550,000 plus 180,333.3561 plus 154,438.148 plus 120,689.4584 plus 93,539.0374, which results in negative 0.0001, which we can round off as 0. So this is the proof that reflects that the total net present value will be 0 if the value for net cash inflows for the first 2 years is going to be 209,203.4294. All right. This concludes the fifth part of this question as well as the entire question number 6 of 2022 February-March paper 3-2. If you found this video useful, make sure you like the video and leave a comment below, and make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.